Welcome to the Weekly Trend, a podcast for navigating the markets through the lens of technical analysis. The Weekly Trend podcast is provided for educational purposes only and does not constitute any professional advice. Listeners should not act upon the information or content without first seeking advice from a registered financial planner.
Welcome back to the Weekly Trend podcast. Today is Friday, August 9th, 2024. S&P 500 currently sitting back at 5325. I'm David Zarling. I'm here with demographic expert Ian McMillan. Great to have you back on here.
Back on. This is, we had one together 2 weeks ago.
Yeah.
But still, it's been few and far between, Dave.
It's summer. It's almost like it's summer.
I was going to say, once we've got school starts in like 10 days. So we're back on track for all the people who are wondering. But now another tough week so far. I guess we got 4 hours till to close. We'll see. But Monday, Dave, did a lot of damage.
It did. A little gap down on Monday. And I think, when you say the term damage, it's just simply, hey, there might be more here than meets the eye. Because I believe that follow through on Monday, if you want to call it that, on something like S&P 500 cash, when we look at that information, because that's what price is just information, we now have ourselves a gap that sits at, we'll call it the 53.75 level, 53.90. That's left the island behind it.
It has. And that is, you don't get that a lot, especially in a big index like the S&P.
Yeah. And maybe we should pause there real quick. So I use the term island.
Yeah. So tell what is an island? I'm going to play Dave here.
Okay. So
I'm going to ask you the definition.
Sure. And so it's when price, there's buying, right? So price is just the interaction of supply and demand. That's what gives us trends. It's what gives us horizontal levels where we've seen sellers show up before. It's the auctioning process. Well, we saw, like the S&P 500 on June 12th, gap above 53.70. So there's a gap in price between the close on that day of 53.75, no price history. The next day on the 12th, we open at 54.09. So there's a gap there. There's a window in price that wasn't interacted in. And then we move higher up into the highest close that we've seen. Once it's close to 5,666, but it's 5,667. We reverse lower. Then Friday, August 2nd, we gap below that level I previously identified. We gap below 5,400, 5,409, and below that close from June 11th. So there's a window in price that sits there on a chart that hasn't been filled, doesn't have to get filled. But that whole process between June 12th and August 1st, so half a month, 2 weeks of information, there's an island of price that sits up there that it will be interesting to see if we ever reclaim it. How did I do?
And we got we had just Thursday through Monday's lows, 8%, Thursday's highs. Because not a lot of damage hadn't really been done until Thursday. And then it happened like markets love to do. It happened very quickly. Yep. And of course, we had the Friday gap down, a nasty candle last Thursday, the Friday gap down, continuation on Monday. We've, rallied a bit. 8% in 3 days is a lot, right? So no February 2020 type action. You had the Monday gap down. What was that Monday? February 24th. And then we kind of just didn't stop. A little bit there, 28, February 28th through the March 4th. So we'll see. And we have a sloping 200-day or above 100. Now, again, things weren't horrible on Friday, February 21st either. So we'll see.
You're talking about February 21st, 2020.
2020. Yes. Yes.
Yes. Yep. And so, yeah, we're here in a moment of time. As I highlighted last week, day moving averages across many major indices.
Which is
We
good.
have we have higher highs and higher lows. So these are all the very definition of an uptrend. Now, do we have some behavior recently that it's worth paying attention to? It's all about context, right? Are we talking about near term? Are we talking about, so like days to weeks? Are we talking about intermediate term, weeks to months? Are we talking about long term to years? Well, markets are a future discounting mechanism. They look 6 to 18 months into the future. That's what people often tend to forget, is that price usurps any type of opinion you have about economic data, the labor market, GDP, earnings releases. In the end, reflects the opinions of all market participants, whether those are rational opinions or irrational opinions.
True.
And here we're in an environment where we still have higher highs, higher lows, a rising 200-day moving average. So that thesis is not nullified, but I would call the last few weeks of information a shot across the bow of an uptrend. If you're going to talk about how does an uptrend end, this might be it. I mean,
Yeah.
you can make the argument as long as we're below 5,400, the chances of the previous uptrend being over is possible.
And I think you like to use this terminology used a little bit yesterday, but I think the market has flipped short to intermediate term, for sure short term, but intermediate term has flipped to where you're kind of, as a portfolio manager, you're kind of like, all right, prove to me that you can actually go higher.
Right. We operate in thesis, right? And the scientific method is it has to prove that it can either be a null hypothesis or it confirms that hypothesis. And so if the hypothesis is we're in an uptrend and we're going to continue to move higher, mathematically, then we have to reclaim 5,400. And so we're in the in-between stage where both theses are currently intact, which is the uptrend is intact. If you were to see a downtrend continue, 5,400, that thesis is also intact. And this is the hard part of managing money is you can operate in an environment that has some ambiguousness to it. And you have two theses that exist at the same time. And a lot of people struggle with that. But as soon as you are self-aware and become aware that there are two theses or theses, however you want to say it, theses sounds too much like feces, so I don't like using it. So theses, two different things that can be true at the same time, meaning rising 200-day, higher highs and higher lows. That's an uptrend that exists.
You're a counter trend move. Things get wonky.
Yes. And the uptrend exists until we have a sustainable close below 49.60, 49.70. That basically the April lows in something like S&P 500.
I think that's the biggest backdrop here. And we will continue to harp on it on the podcast. We sent out a client letter, on Wednesday?
Yep.
And we will harp on it here, or harped on it there as well. We're above 4,800 and we have an upward sloping 200-day, both things you pointed out. So right now, even if you think we get a final flush, you have to err on the side. I mean, we could fall another 9%. You're still above 4,800. And you have to err on the side that this likely revolves itself. Now, if we do go back to 4,800, you're going to lose the 200 day. That's just mathematically going to happen. Unless it somehow happened it could we'll see. But yeah, it's wonky. It's weird. There are a lot of mixed signals. We spend the month of July talking about breadth improving, and I would say that's still the case. I mean, yeah, they've all gotten hit on a relative basis. I think that still holds true. You've got tech below substantially below a relative 200-day. Well, you have other areas hold it now. materials, maybe not so much, but financials, energy has held up well. I'm not saying it's rocking and rolling, but on a relative basis, it has not gotten killed during any of this. Real estate, so we'll see.
Yeah, and it just goes back to, does the information that's been provided confirm or refute the thesis at hand? One thesis being rip roaring. I think it's important to remember we're Bayesian, right? So the most recent information is valued more. We've seen kind of this shot across the bow. At the same time, we just came off of a period from late October 3 through July that is in the top percentile of moves in a market. Do we really get to be surprised if we move sideways from end of July through October, November
Yeah.
to digest that move?
We talked about it. I mean, that was a move you get once a decade.
Right.
And either you were there for it or not. And now how do you handle it going forward? Long term, you've said you want to pull up a multi-decade chart of the S&P. Is still there aren't a lot of major cracks long term. And what if if we are going, which everyone has whined about, I'm not saying that we haven't, for 2 years about getting out of this Mag 7 overwhelming power it has. I mean, if we're truly going to rotate out of that, it's going to probably be kind of nasty.
Yeah. And the
if we
cracks are
can
there.
do that while still staying in an uptrend, that would be impressive.
It would be. This goes back to the generals and soldiers on the field, that if the generals
die, but the soldiers are somehow still there to carry on the battle.
Could be. Yeah, could be. And I think that brings up another point, really. When you look at the leadership that came out of October of 2022, your Eli Lilly, your NVIDIAs, those haven't cracked yet. So NVIDIA hasn't cracked. And what I mean by that is, like, when you look at NVIDIA versus SMH, semiconductors, still leading. When you look at Eli Lilly, still leading. But to your point, some of the Magnificent Seven, the Mag 7, I mean, we've officially reached peak sentiment when we went from Magnificent Seven terminology to Mag 7.
Mag 7, we got all the ETFs. They started coming up.
Yep.
Mag 7 ETFs.
Yep. They're even launching a top 30 NASDAQ ETF.
No, they're not.
Yes. That's just been filed. So we have that sentiment going on now. And I would make the argument, when we talk about Mag 7, right? Your Microsoft, that's basically the top 7. Apple, NVIDIA, Google, Meta, Amazon. I haven't said 7, but people get the point. When we talk about those, when you look at them both on an absolute and a relative basis, there are cracks there.
All right. So what do we got? What are your levels here we're watching?
So if we look at Apple, like, if we can't, right? Because that was a range, the top of the range that existed from summer of 23 into summer of 24. The top of that range was 197, 198. We cleared that level in June. We've since come back and tested that level. If we can't keep that level, basically meaning buyers don't have control, then that's at risk. If you look at Microsoft, the low that exists from April, let's call it 390. I'm using roundish numbers. You could get really picky and say 387, but let's say 190.
Yeah.
If we can't hold that, that's a little bit of a problem.
And we're below the 200 day.
Yep. And you highlighted that before we hopped on here. There's a lot of these that are battling below its 200 day, like Amazon. I mean,
Amazon. Yeah. And discretionary is already, just consumer discretionary. If we're going to go by our spider sector ETF, it's the worst sector. Now there's things, right? I have the discretionary workbook now for the team. So going through that, there are things under the surface that aren't horrible. But when you got Amazon there below a 200 day, and what really, I'm going to be honest, I'm going to call like kind of rising wedgie-ish back into it and back into this 168. I tell you right now, I'm not buying Amazon here.
Right. Yeah, it's got this earnings gap to the downside. And you could argue Amazon is also trying to figure out if it's going to be an island reversal, because below 168, there's a gap that exists going back to February in Amazon. Then if we move lower, you'd also be leaving some price history that has gap type behavior. And so that's a little bit concerning is the way you would put it.
A lot of polarity at 168, even going back to 2020 on Amazon. Lot of whipping around that. That is a big level. I'm telling you, this stuff is not random. Once you see it on a chart, you cannot unsee it. I think that's probably what leads us to all be technicians.
Well, yeah. I mean, look at something like versus S&P cash. Telling me that we reverse on a relative basis at the same price level we were at the dot-com bubble back in 2000, or even like the Nikkei,
yes,
which reversed hard. You know, like we're talking about the 1989 high, reversing hard there.
So hard. And that was the big thing that caused the Monday sketchiness was the Sunday night. God, I was on a 10-hour car ride watching this happen. So that was super fun. I mean, down 25% since mid-July, down 20% since just last Thursday through Monday, 20%. I mean, the media would tell you right there, you had a bear market and right. I mean, that's a bear market right there because they like to use things like hard round percentage numbers.
And isn't it interesting that get there in 34 years, 34 being a Fibonacci number, that in 34 years, we finally get back to the levels in the Nikkei, the Japanese index, that we haven't seen since 1989. And we immediately respond price-wise to that level.
And it's a failed breakout. I mean,
right.
Because I remember us all, I was there in February talking about Nikkei, above 40,000. And now we got a failure. And that goes back to the base. I mean, hey, it was cool. And then it didn't last. So now what is your mindset?
Yeah. And there's a couple of theses, right? It's now that has failed, is it immediate downside ongoing? So a failed breakout, or is it some type of Wyckoff presentation where price wraps around the prior high, shakes out as many market participants as possible, and then moves higher? Time will tell. And I think for the Nikkei, right, we saw price drop all the way to 31,200 and then rebound.
Yes.
If we can't hold 33,700 on the Nikkei, there's probably problems.
Well, and here's the thing, right? Okay, a 35-year base.
Yeah, 34 years.
Year base. I'm going to be honest with you, as someone who has looked at tens of thousands of charts, and you can make this as fractal as you want. But this type of chart, this type of base, probably this type, this type of cup, probably going to get a handle with it. That's just the way. I mean, you usually just get some consolidation up here.
Right. I
don't like using we're not big on chart pattern terms and necessarily all of that, but it's likely. And here's the thing, Dave, we are talking about a 34-year cup. So how long is it going to make that handle? Probably more than a year or two.
Yeah.
And we could have that. We could trade in between 30 and 38,000 for 3 years. And that's a pretty big range.
Yeah.
But in the grand scheme, and when I say grand scheme here, we're talking about decades and decades and decades. It's the healthiest option.
Yes.
And that's why I say, like, if you're going to view it, like if I saw this on a daily chart and it was some like 3-year base, and the right side of that base had been attacked pretty aggressively, then I would assume that we get some type of consolidation, or as you said, some type of Wyckoff whip around nastiness for a bit.
Yep. 100%. I mean, they in the end, they do have to work through that behavioral behavioral supply and the Nikkei. You don't get to move into those price levels and potentially not work through them. Sometimes it happens. I mean, it does happen in charts that you look at that price just moves through and like a hot knife through butter.
Yeah. And that's bullish.
And that is bullish, but that's not what we're seeing and I'm not saying it's not bullish. I'm just saying that you look at something like the Nikkei having to work through that very important price level. We'll call it 40,000 for a round number. The same thing we see with Bitcoin. I mean, Bitcoin really struggling to fit through a price level at, I'm going to call it, so I would call this more of a Wyckoff, right? 65,000 on Bitcoin. We've wrapped around. So 65,000 is the weekly closing high from November of 2021. So for 3 years, Bitcoin hasn't gone anywhere. I mean, it's had heartburn in between. And now we're wrapping around those prior highs at 66. That could take some time. It could take a couple more months to work through 66,000.
This has been gross for 6 months. Nasty, big ranges. And you know what? It's the right side of this base from 15, 16,000 up the way to 70, 71. That's a pretty aggressive. It was not a straight line, but I mean, yeah. And Bitcoin short term, we talked to, put it on the 200-day moving average rejection list.
Yeah.
We'll see. But
Paul Tudor Jones, one of the best investors, said nothing good happens below 200-day.
Nothing happens. Upward sloping or no, nothing really happens.
Yeah, nothing good. Got to be above a 200-day moving average. To your point, Bitcoin is not, Amazon is not. There's other instruments like Microsoft is not, Google. It's worth paying attention to some of these things. Google is above a 200-day moving average, but some of these other bigger instruments, it's worth paying attention. It's at least there's another thesis here. So as bullish as we might have sounded in the last few months, it's worth paying attention to what's the alternate? What's the other side of the coin? What does the downtrend look like? And so Apple 198, Microsoft 390, Google 146, Nvidia 75, Amazon 156, Meta, Facebook at 428. If we can't hold those, that means sellers have control.
What about indices?
Indices, small,
Small, dude, this kid, I'm done with. No, we're done. We're done with dude, we couldn't hold I'm fine with the pullback, but we couldn't hold 210.
Yeah, it'd been nice.
It would have been nice. It's just now we're back in and maybe this is it is a mess. This was messy in 2021.
Yeah. Yeah, small caps have been a hot mess since 2021, both with the frost breakout in November of 21 through now. I mean, the near term range that in July, the range that happened and then breaking lower, you kind of wanted to see that range break higher. We didn't. Again, also happening in a backdrop of seasonality where we know August can be. In fact, I think we're changing our family vacations. I think we're going away from any family vacation.
I'm so done.
We're not doing August anymore.
Dave and I made a blood oath to each other yesterday.
No more family vacations in August.
I can't. Because you scoundrels want to change things up.
Every August.
I guess to be fair, I do look at the seasonality charts all the time. And it tells you, hey, August is kind of screwed up month. Oh no, we'll be fine. We've got incumbent election year seasonality. We should be okay.
Yeah. Yeah. You've highlighted that. And that's a good thing to highlight is, can you walk people that are listening to this through this, the difference between an incumbent seasonality election year and a non-incumbent year seasonality?
I can do that because I walk my wife through this on Sunday night in the car. So seasonality, it can be divvied up multiple ways. What the over the course of a year from pick any index, we'll use the S&P. And so one of the most popular ways to divvy that up is by where you're at in the election cycle. So we're obviously in an election year. And so we have multiple types of election years. You can have election years with an incumbent or an election years with no incumbent. So we, going into 2024, had an election year with an incumbent, and we were getting the seasonality we expected. I'm not saying it doesn't matter what the incumbent's approval rating. We're not going to that levels. We're not talking about if people like them or not. We're talking about election years with an incumbent, period. For the most part, pretty smooth. You get in, it's pretty good because at least if he gets reelected, markets know what they're going to get from it. So we had that obviously late whenever this happened, mid-July, late July. We now have an election year with no incumbents, 2 new candidates. Now you can say Trump is a former president. Yeah, that's true. Again, literal definition, he's not an incumbent president. He's a former president, not an incumbent president. So those years look much higher volatility, much more sideways. So we kind of are now, are we going to get that season out, which especially really kicks in August.
Yeah. I mean, if we're getting a non-incumbent seasonality, we have a lot of catching down to do.
We do. Or we just sideways and weird for a bit.
Right. Again, all within the context of it's still confirmed that we have an uptrend on our hands. Just if you're going to see a downtrend commence, a shot across the bow, this is kind of what it would look like. This island reversal potential below below this, what would we call this? 35, we'll call it 5,400 just to be the wrong number for people to remember. Below that, do we have an island reversal on our hands and we're moving lower? Could be. Again, this has to do with the battle between near term, intermediate term, and long term. We still have an uptrend on our hands, but if we're going to see a reversal, this is kind of what it looks like.
That island, Dave, it was yesterday or Wednesday when you brought that to my attention, but I don't know, man. It's just not a good look.
It's not.
And we're in a strong bear market. We could be here in late September, mid-September, and you can all be sending me messages about, we could slice right through it. I don't know. But it's just not, I don't know. Because if we were bearish or if it was to the upside, Dave, I'd feel the same way, but opposite. And I'd be like, right. Holy cow, like this is, we could get a retest here, but this is a good omen. An island reversal to the upside, that's a good omen. And so if we're going to sit here and be honest with ourselves as market participants, as technicians, the island reversal to a downside it's not a good omen. Now we've got a backdrop of a lot of things that we've talked about. So I'll give it a half score on the bad omen report.
Yeah, it's definitely, it's a piece of evidence that fits the thesis of, this is maybe how a market correction starts. We're not there yet because we haven't closed below 5,000. We still have a rising 200-day moving average. Typically, you see move sideways in a range to get the 200-day moving average to move sideways, and then we capitulate to the downside. Distribution takes time. It's not like institutions can unload their shares overnight. Like if this is a multi-year or a multi-month correction that takes us 20 to 50% lower, I'm not here to tell the market what to do. It doesn't have that blow off tops piece to it. Typically distribution takes time. And so we'll see. I mean, it's hard because as people are listening to me say this, like it's not a blow off top. Could be.
I mean, look at 2014, 2015, what happened with that distribution.
Right.
I mean, look at the first half of 2015.
Worked just fine.
And then you finally get your craziness for a couple of years. We all know what happens. November 2016, yada, yada. Yeah, it takes time. And
that's the hardest part.
We could go below the 200. I mean, in 2008, you had a couple trips below the 200 day before you finally stuck it. In 2022, you had a couple trips below the 200 day before it finally stuck. and it's started to fly. I mean, yeah, it takes a lot, as we like to say, it takes a lot to turn an aircraft carrier around.
Yeah, this is not one of those things where like, is this like an Eiffel Tower? I'm saying that with the Paris Olympics happening. Is this some type of blow off top? We don't know that until afterwards. Like all this stuff that we talk about, if the media, financial media gives the impression that somehow they know this beforehand, there's no way. No, they don't. They don't know. And that's the hard part about markets is we do not know the future. We want to know the future. We do not know the future. And so what happens? You start taking in information that you wouldn't normally take in order to try to think, oh, this is predictive. Like I'm going to try to predict the future. We simply don't know, but we do have math. We do have charts. We do have supply and demand. We can say, hey, there's a gap in price that exists at 5,400. Below that, the thesis of further downside is intact. Above that, we see the market continue to the upside. And so there's a little bit of no man's land here. We still have higher highs and higher lows. We still have a rising 200-day moving average. Where is our sentiment at? We still haven't seen put call ratio blow out. We've seen
right. Good point.
We've seen VIX blow out, meaning, we had VIX sitting in the high 60s or mid 60s.
We talked about that in the client letter. First ever 1 day move of 40. And now it didn't close, but we had an intraday move of 40 points from 18. You went from 16 to 66. That's, and you could say that's like overdone. We'll see. Is it overdone? Now you still have an elevated VIX, even at 22. You're still expecting 1 day swing, 1% swings every day.
Using the rule of 16, right? If the VIX is above 16, you divide by 16, you get 1% moves. It's above 30, you're going to get like 2% moves. But we haven't seen VIX, a volatility instrument, in the 60s, mid 60s, since the COVID crash.
We didn't even get there during Volmageddon.
Right.
We didn't get there election year 2016. Yeah, that was a lot. That was now, and we don't know. Is it an overreaction or is it a sign of things to come? Obviously we've got to like come back down to earth a little bit, but is it a sign of continued higher volatility? And then what does that mean, Dave? Because we talk about volatility in the late 90s was up, and so are markets.
Yep. It can continue to happen. And again, it's this Bayesian process of taking the most current information, weighing it versus the past. So the past information that we have, higher highs and higher lows, uptrend, rising 200-day moving averages, uptrend. Yes, we have breadth that's reversed into O's using bullish percent, which means that the other team has the ball midfield.
Golly, and we had just reversed into X's.
We had just had the offense had the ball, so they punted again. When you look at it in context, August, that's not all that surprising that would happen. That you would then try, if you're up 3 touchdowns and it's 2 minutes to go in the half, you're not trying to like force an interception or anything like that. You're going to punt the ball. So we're kind of in that environment. It's a both and this is the part where most investors struggle is they want black and white. There's no such thing as black and white in markets. It's not binary like the Olympics. You have multiple outcomes that could happen. You have multiple theses that are in place. At this point, the major two that are in place are higher highs and higher lows in most U.S. indices, a rising 200-day in most U.S. indices, with the caveat that there's been a little bit of change in behavior by the incredible amount of participants, the trillions of dollars at play below this 5,400 level. And really that's what it comes down to is if we can't reclaim 5,400, the problem. And at the same time, if we hold 5,000 or 4,900, everything is fine. Even though that feels uncomfortable, if we hold that level, and it's kind of one of those things where like when you're observing, you can observe sports, you can observe hunting. Like when you're hunting, you have a easterly wind or you've got some type of food plot. It just looks like the buyers and sellers want to interact at the 4,900, 5,000 level and see who's boss. And we get there, maybe we don't, but below 5,400, that thesis is in play. And so now we're in this, I want to call it, it's not no man's land. It's kind of like no man's land, but we have multi potential on our hands, and you just have to be able to be open-minded on outcomes. You can't get married to your opinions on this.
Not a spot to be aggressive. If you had a good November through July, and again, as we just said, one of the greatest rallies we've seen in a long, long time. We're probably up off the October lows. If you went trough to peak, 38%.
Yeah. And we can't forget those breath thrusts either. That look
9 months, 38%.
Like it is perfectly normal if we digest here. This is the part of the market cycle where things get a little messy and people can overtrade, and you just have to be calm and observe what happens with price. Watch the interaction of supply and demand. It's one of the most beautiful things in markets, right? Because if we have selling pressure, which obviously we have on our hands since the beginning of August, right? It's one of the worst starts to August since we've seen in the last 2 decades. So obviously there's selling pressure. There's a seasonal backdrop of uncertainty with the election cycle, incumbent or non-incumbent. And so you sit there and you observe, you sit back, you sit on the park bench. It's one of them. I love going to the airport and you're going to take off for a flight, but you're sitting there observing people, or you go to the park or you go to a concert. And there's a part where you're participating in the concert and there's a part where you're observing the people. We're in this observing the market part of this environment where what are we going to get here? Are we going to get back above 5,400 or are we going to go test 5,000, 4,950 and see if the buyers that bought there in mid-April are still there? It's why I'm so thankful for Chartsy. And I don't know how else everybody does it, because you could, in some economic or earnings perspectives, you could say, oh, things are an extreme. In other ways, you could say they're not. It's why price matters most.
Has to matter.
So with that, I want to highlight the supporter of this podcast, the Adaptive Select ETF, listed on the New York Stock Exchange under ticker ADPV, which helps investors access 2 of the most prevalent factors in markets: momentum and relative strength. Proprietary identification methods, the Adaptive Select ETF attempts to own the strongest 25 large cap stocks when the market is in an uptrend. Since not all market environments are the same, Adaptive Select seeks to prevent extended declines by moving to short-term treasury bills and cash during long-term market downtrends. You can find out more, including how to invest in ADPV, by visiting with aid.com or calling 1-833-880-5200. Investing involves risk, including possible loss of principal. Distributed by Quasar Distributors, LLC. We are close to the end of our time. Anything else you want to highlight, Ian, for our listeners before we ask them to give us an amazing ranking and share on their favorite platform?
I know they will give us an amazing ranking. No, I think you got to accept the fact that October through July is what it is. And you always know in the back of your head, this will not last forever. I think we've reached that point, at least for a few months. And again, I don't know if it's a correction through time. I don't know if it's a correction through price, but I think we've reached the point of, again, if we are below the island gap at 5,400, definitely reached the point where, you're not leveraged long we're not in the left-hand lane. I'll tell you that. I'm not in the left-hand lane anymore. Going 85 and a 70.
Taking some risk off the table. If we get back above 5,400, good to put the foot on the accelerator again. There's some traffic cones. We've got some flashing lights. Just pay attention to those. You drive safe. You both hands are on the wheel. You're not distracted by the radio or your kids. Same thing that you're highlighting in this market is there's a shot here. There's some warning signs. Does that mean we have a full-on traffic jam and they're going to divert us and we're going to go the other way? It doesn't, but it's worth paying attention. It's worth seeing, what does price do here? Are we going to reclaim 5,400 or do we not see 5,400 for months to come? And we won't know that mathematically until we're below a 200-day below this really important level at 49.75 on the S&P 500. We won't know that, but we're willing to live in that. We're asset managers. This is what we do. We manage risk. So I love that point that below 5,400, there's some increased risk. That doesn't mean this run is over. Seen plenty of bull runs in the past, Ian. We're market historians. The 90s saw corrections like this all the time. In fact, most years have a correction that's 10% in nature, and that's perfectly normal. And that would happen in August and September, perfectly normal. And we could be finishing higher from here by the end of the year in dramatic fashion and also lower. That sounds a little bit wishy-washy, but that's the reality. Anything else, Ian, before we wrap it up?
No. Head on a swivel out there.
Absolutely. Got to be a market athlete. Got to be nimble, understand the price levels, see where supply and demand interact. It's the biggest thing. So it's great to be back on here with you. I'm glad you got some time off. It's a beautiful thing. With that, those who are listening, we hope you give us a high ranking, share with others. We do this for free. That's a way that you can pay us back, and we really appreciate it. So thanks again, Ian, for being on here with me.
Have a great weekend, everyone.